Imagine waking up one morning, opening your phone, and seeing that the stock market has dropped 20% overnight. Your investments are falling. News channels are shouting about a recession. Social media is full of panic. People everywhere are saying the same thing. The market is crashing. And in moments like this, most people do exactly the same thing. They panic. They sell their investments. They move everything into cash. But here's the strange part. While millions of people are trying to escape the crash, the top 1% are quietly preparing for it. In fact, many of the wealthiest investors in the world don't just survive crashes, they often come out even richer. So the real question is, how do the wealthy protect their money when everything seems to be falling apart? And more importantly, what do they understand about money that most people don't? For most people, a market crash feels like a financial disaster. When prices drop, it feels like money is disappearing. Imagine someone who invested $50,000 in the stock market. Everything looks great when the market is rising, but suddenly the market falls, and that $50,000 becomes $35,000. It feels painful. Not because the investment is permanently gone, but because humans naturally hate losing money far more than they enjoy gaining it. Behavioral economists call this loss aversion. The pain of losing $1,000 often feels twice as strong as the happiness of gaining $1,000. So when markets crash, emotions take control. People stop thinking like investors, and they start reacting like someone escaping danger. They sell, they panic, they promise themselves they'll get back in later. But ironically, this emotional reaction is exactly how many people lock in their losses. Meanwhile, the wealthy approach crashes very differently because they understand something most people don't. A crash isn't just risk, it's also opportunity. To understand how the top 1% protect wealth during a crash, we need to understand a simple idea. The wealthy don't just focus on making money, they focus on protecting it first. And they usually follow three key strategies. These strategies are not complicated, but they are built around behavior, patience, and preparation. The first strategy is that they expect crashes. Most people treat market crashes like rare disasters, but experienced investors see them as normal events. If you look at financial history, crashes happen again and again. Markets crashed during the dot-com bubble, they crashed during the housing crisis, they crashed during the global pandemic, and every time, people believed this time was different. But eventually, markets recovered, and those who stayed invested often came out stronger. The wealthy understand something simple. Markets move in cycles: booms, slowdowns, crashes, and recoveries. Trying to predict every crash is almost impossible, but expecting them changes how you prepare. Instead of panicking when markets fall, the wealthy build portfolios designed to survive volatility. They know storms will come, so they build stronger financial ships. The second strategy is liquidity. One of the most powerful things wealthy investors do is surprisingly simple. They keep cash reserves. At first, this may sound strange. After all, we often hear that cash is losing value because of inflation. But for wealthy investors, cash serves a different purpose. It provides flexibility. Imagine two investors during a market crash. The first investor has all their money invested. When the market falls, they can only watch their portfolio drop. But the second investor kept 20% of their wealth in cash. When the crash happens, something interesting occurs. Instead of panic, they see discounts. Companies that were expensive months ago are suddenly much cheaper. Stocks that were selling for $100 are now selling for $70. This investor now has the ability to buy opportunities when others are forced to sell. For them, crashes become shopping seasons. This is one of the quiet advantages wealthy investors have, not because they are smarter, but because they are prepared. The third strategy is diversification. Many people believe wealth is built by making big bets, putting all your money into one great opportunity. But wealthy investors often think differently. They protect wealth through diversification. Instead of relying on one investment, they spread their money across multiple assets: stocks, real estate, businesses, bonds, private investments, sometimes even commodities like gold. This creates something powerful. When one asset struggles, another may stay stable. Imagine owning only technology stocks during a tech crash. Your entire portfolio could collapse. But if part of your money is in real estate, another part in global markets, and another part in defensive investments, the overall damage becomes much smaller. Diversification does not eliminate risk, but it greatly reduces the chance that one event destroys everything. And for wealthy investors, protecting wealth is often more important than chasing the highest possible return. But the real difference between wealthy investors and everyone else is not just strategy, it's psychology. The wealthy often think about money using a completely different mindset. Most people think about investing like this: how much money can I make this year? But wealthy investors often ask a different question: how do I stay in the game for the next 30 years? This mindset changes everything, because wealth building is not a short sprint, it's a long endurance race, and crashes are simply part of that race. Imagine two runners. One runner sprints too fast at the beginning and burns out halfway. The other runner moves steadily, saving energy and adapting to obstacles. Who finishes the race? The second runner. The wealthy apply the same thinking to investing. They avoid extreme risks. They focus on survival. Because if your money survives long enough, time begins to do most of the work. Compounding starts taking over, and that is where real wealth is created. Not from one lucky investment, but from decades of steady growth. So, what can everyday investors learn from this? You don't need millions of dollars to think like the top 1%, but you can adopt the same principles. First, accept that crashes are normal. They are not signs that investing is broken. They are simply part of the financial cycle. Second, avoid investing money you might need in the short term. When people panic during crashes, it is often because they need their money immediately. Having an emergency fund removes that pressure. Third, diversify your investments. Instead of trying to find the single perfect opportunity, focus on building a balanced portfolio. And finally, remember that the biggest advantage in investing is often time and patience. Many people try to outsmart the market, but often the most powerful strategy is simply staying invested long enough. At first, a market crash feels like chaos. Prices are falling, news headlines are spreading fear, investors are rushing for the exit. But if you step back and look at history, crashes reveal something important. They separate two types of investors: those who react emotionally and those who stay prepared. The top 1% are not immune to market crashes. Their portfolios fall just like everyone else's, but because they expect volatility, keep liquidity, and think long-term, they don't just survive crashes, they often use them as opportunities. And maybe the most powerful lesson is this: wealth is not just built by making money when markets rise, it is built by protecting money when markets fall. Because in the long run, the investors who stay calm during chaos are often the ones who quietly build the greatest wealth. And sometimes, the biggest financial advantage is not predicting the future, it is simply being prepared for it.